Every major modern economic collapse shares a singular, hidden DNA. While the public perceives a market crash as a chaotic natural disaster, the elite view it as a calculated, cyclical event for the redistribution of wealth. The primary difference between those who lose everything and those who build generational fortunes is not luck. It is the transition from being a reactive observer to a prepared participant. For decades, the standard financial narrative has remained unchanged. Market crashes are unpredictable. Diversification is your only defense. And attempting to time the market is a fool's errand. While this advice keeps the average retail investor from making impulsive errors, it is fundamentally designed for those who cannot move massive amounts of capital without alerting the entire market. Meanwhile, the ultra-wealthy, those whose private wealth reports and SEC filings reveal a different reality, operate from a playbook that begins nearly 2 years before the first signs of a downturn appear. By analyzing these patterns, we can identify 5 specific assets that the elite use to not only survive the storm, but to systematically acquire the productive capacity of the world at a discount. In the lexicon of institutional wealth, boring is synonymous with lethal. Leading up to the 2000 dot-com bubble, the 2008 financial crisis, and the 2020 pandemic shock, a consistent pattern emerged in the 13F filings of the world's most successful investors. They were not chasing the latest tech trends, nor were they heavily rotating into gold or real estate at peak prices. Instead, they were accumulating short-duration government paper, such as 90-day treasury bills. A prime example is Warren Buffett's Berkshire Hathaway, which amassed over $130 billion in cash equivalents and T-bills by mid-2023. At the time, critics labeled this move as overly conservative, suggesting the Oracle of Omaha had lost his edge. In reality, he was loading the gun. The ultra-wealthy do not view cash as a drag on their yield. They view it as a unique asset that can be converted into any other asset at the exact moment those assets are bleeding out. During the 2008 crash, the S&P 500 lost approximately 57% of its value. An investor holding $10 million in T-bills not only avoided this loss, but maintained the full $10 million in purchasing power at a time when world-class businesses were selling for 50 cents on the dollar. This is the liquidity preference documented by the Knight Frank Wealth Report, showing that the elite began positioning themselves for safety years before the average person realizes there is a problem. For the individual investor, there is no structural barrier to holding cash or T-bills. There is only the cultural conditioning that tells you such a simple move is a missed opportunity. The second asset class is one that conventional finance rarely explains to the public because it reveals the market as a transfer mechanism. This asset is distressed debt. When a corporation nears bankruptcy, its bonds often crater, trading at 15 to 20 cents on the dollar. While retail investors flee in a panic and the media writes obituaries for the company, sophisticated capital arrives to buy the debt. The genius of this strategy, championed by figures like Howard Marks of Oak Tree Capital, is that buying distressed debt is not a gamble on a company's survival. Rather, it is a legal mechanism to take ownership of a company's physical assets, factories, logistics, and real estate, at a fraction of their replacement cost. For the individual investor, there is no structural barrier to holding cash or T-bills. There is only the cultural conditioning that tells you such a simple move is a missed opportunity. By purchasing debt at 15 cents, These investors often emerge from bankruptcy as the new owners of the restructured company. A notable instance occurred in 2009 with General Growth Properties, a massive mall operator. As its debt traded for pennies, Brookfield Asset Management accumulated a significant position. When the company emerged from bankruptcy, Brookfield held a controlling stake in a multi-billion-dollar empire of 200 shopping malls. This mechanism effectively transfers productive assets from dispersed public shareholders to concentrated private capital. While high minimum investment thresholds often exclude retail investors, understanding this process is the first step to seeing whose interests the financial architecture truly serves. The third asset is perhaps the oldest form of wealth in human history: productive farmland. Unlike stocks or digital currencies, land that produces food has a value floor built into it known as caloric necessity. Regardless of inflation, currency collapses, or bank failures, human beings still require biological fuel to survive. Data from the Knight Frank Farmland Index shows that between 2000 and 2020, prime American farmland appreciated by over 500%. It did not buckle during the dot-com crash or the 2008 crisis, and it even gained 7% during the 2020 COVID shock, while commercial real estate plummeted. This explains why Bill Gates has quietly become the largest private farmland owner in the United States, holding approximately 270,000 acres. This is not a new trend. It is a recurring historical theme. From the Roman patricians expanding their massive latifundia during debt crises, to speculators buying German farms during the 1920s hyperinflation, land remains the ultimate hedge. Modern data further clarifies that land connected to export crops, like coffee or cacao, retains its value even if the local currency fails, because its value is anchored to global demand rather than a single failing jurisdiction. 4 to 6 months before a market dislocation, the private treaty sales departments of auction houses like Sotheby's and Christie's see a massive spike in activity. These are direct, referral-only transactions between collectors that happen outside the public eye. History shows that private art sales hit record volumes in 1999 and 2007, just before major crashes. Fine art by established, deceased masters is highly valued because it has zero correlation to equity markets. When the S&P 500 fell 57% in 2008, the top segment of the art market fell by only 4%. The logic is simple: supply rigidity. A central bank can print $3 trillion in a month, as the Federal Reserve did in 2020, but it cannot print another Gerhard Richter painting. Money chases scarcity when that scarcity cannot be inflated away. Additionally, the opacity of these private deals allows the ultra-wealthy to move wealth through complex structures without public indices tracking the discounts or the movement of capital. The final asset is not a defensive store of value, but an offensive tool for wealth creation. Essential service monopolies. In the months following a crash, sophisticated capital targets businesses with inelastic demand, services people cannot stop using, regardless of the economy. This includes waste management, funeral services, self-storage, water infrastructure, and medical waste processing. The economic profile of these businesses during a downturn is almost perverse in its advantage. Revenues remain stable, Families still generate trash and require storage when downsizing, while labor costs often fall due to high unemployment. During these times, larger entities or private equity firms buy out smaller, over-leveraged competitors at liquidation prices. Wayne Huizinga used this exact strategy to build waste management into a giant by acquiring small regional operators during the mid-1970s recession. These unglamorous businesses are often ignored during boom times because they lack a disruption narrative, meaning they aren't overpriced when the crash hits. They are undervalued in good times and become dirt cheap in bad times, all while their cash flow remains intact. Ultimately, the data suggests that economic crashes are not random. They are predictable, cyclical events where capital flows from the panicked to the patient. The middle class is taught to fear crashes as something that happens to them. But for those positioned correctly, a crash is merely a scheduled shopping event. The principles of generational wealth. Treating cash as ammunition, seeking caloric claims on the future, and owning essential cash flows do not require a specialized account to understand. They require a willingness to look at what the elite are actually doing, rather than what they are saying in public. As the shadows of the next market shift begin to lengthen, the only question that remains is, where do you want to be standing when it arrives?